GreenGrowth CPAs first ever cannabis tax talk, where we're going to be talking with a couple of our cannabis professionals and answering your live questions. So we're just going to wait a moment and let the room fill up and make sure everyone's here, and then we'll get started. Just 1 minute. All right. And before we get started, I just wanted to say that none of this is official tax advice, and so we take no responsibility if you use any of the things we say. We're just having a conversation here. If you want professional tax guidance, please reach out to us, and we'll get you all set up. So let me bring on our tax experts. Here we go. Hello, Natalie and Jessica. Thanks so much for joining us.
Hi, Chris. How are you?
We're doing great. Beautiful
Good.
day here in sunny California. Before we get started, you mind just telling us a little bit about who you are, how long you've been doing taxes, that kind of thing? Go ahead and start, please, Natalie.
Well, hi, my name is Natalie. I have been in public accounting about 30 years now. The first 25 years of that was spent in a medium sized CPA firm. I'm based here out of Las Vegas, Nevada. And I've been in the cannabis space and with Green Growth since basically day one.
Wow, that's great. You are one of the rocks our entire company is built
That's,
around.
that's a little bit of an overstatement, but thank you.
Let's see. And Jessica, how about you?
Well, I'm Jessica. I'm based out of Nebraska. I have been a CPA for almost 10 years now, all of which my time has been spent in the tax industry. And I also do have a little bit of a background in the finance world. I have a CFP as well. I've had that for not quite as long as the CPA, but I've been spending a lot of time lately working with our clients on maximizing their deductions in the cannabis world on their taxes.
Yeah, that's the biggest key, right? With all the issues, it's all about deductions, navigating 280E, and trying to do your best to operate like a mainstream business. So we'll be answering a few questions we got through Instagram. We'll get to that a little bit later. And then anyone who's out there watching, please drop any questions you've got into the chat, and we'll do our best to answer them live. But first, I just want to talk about just got out of the 10/15 tax deadline. And
Boy.
thank you so much to the two of you and the rest of our great tax team working day and night to get everything done. You guys did a wonderful job, and we actually set records for the most we've done. The industry is growing fast. Our client base is growing fast, and you guys are still doing a great job maximizing deductions and helping everyone get tax compliant. We do just want to start off by talking about a little bit of best practices. What did we learn from this most recent tax season? What kind of recommendations do we have for folks? So we get to best practices for filing. Talk to us a little bit about when people should be preparing their financial documents and then submitting them to their accountant or CPA. Natalie, why don't you start us off there?
Well, I mean, you should really start looking at your stuff today. At the end of the year, now is a good time to sort of take a look at your year. Depending on what you're looking at cash wise, you may want to take a look at maybe buying a new piece of equipment or, making some financial decisions before the end of the year. And then, treating your business like a business, basically. This is an industry, it's getting better now, but it's skewing a little bit younger and a little bit more inexperienced. So it's just very, very important to treat this business like a business and not run, your individual or your personal expenses through a business account if you have one. I know this is cannabis. A lot of you don't have business accounts or bank accounts, but just treating it like a business and just making sure that you are recording everything that happens, all of the money that's coming in, all of the money that's going out. There's a big misconception, I think, with a lot of people that they think, well, I have this expense that is not going to be deductible. I know it's not going to be deductible, so I'm not going to give it to my accountant. Well, we need everything because we need to balance off a bunch of stuff. I mean, I'm not going to get into that later, but we need to balance off everything. So even if an expense is not going to be deductible and you know it's not going to be deductible, give it to us. And maybe there's a way we can maybe make it deductible. A lot of banks in the state of California are now hooking up into Metric. And so there is an inventory component to those bank fees now that they're charging you. And so maybe we can use a little bit of those bank fees that normally would not be a deductible item because it's linked into inventory we can maybe use.
Yeah, absolutely. So kind of the key there, timing wise, is the earlier you get this information to us, the more time we can spend reviewing all that. Jessica, can you talk a little bit about like optimal timing and what the advantages are of getting that financial information to us as soon as possible?
Yeah, so there's definitely an advantage to getting your information to your tax preparer early because then there's more time for us to do kind of what Natalie was talking about is when she said, maybe there's a way for us to make something deductible. And in order for us to be able to figure that out and try to do that, there has to be a discussion. So there's some questions that we have to ask, some information that we need from you in order to be able to make some things at least partially deductible. And so the earlier you get us your stuff, the more time we have to look through that, ask you those questions, and the more time you have to gather the information that we're asking for in order to make at least part of it deductible. The other big advantage is for your own planning purposes. And so what I mean by that is if you have all your stuff ready to go and you file, like, let's say first thing in February, and you're like a partnership or an S corp that's due in March, or a C corporation is not due till April. If you file that beginning of February, your taxes aren't due any sooner. So you still have until that March or April deadline. And what you're doing then is you're just giving yourself more time to plan ahead for that tax bill and figure out like how you're going to structure the funding for it, whether it's going to come from this bank account or this loan or this investor or however you're going to structure that. You have more time to plan for it instead of scrambling at the last minute or maybe not even being able to pay it out on time at all and then incurring the interest and penalties and things like that from the IRS. So the sooner the better, just for planning purposes and also maximizing those deductions.
Yeah, that's a really great response. I mean, the difference between finding out you have a $10,000, $100,000 tax bill the day it's due versus several weeks or months before it's due, it's pretty obvious. So that's a great
Absolutely.
point. And related to that too, I think there's part of the cannabis culture is people coming out of, say, the black or gray markets, and there's still a little caginess, a little defensiveness to the questions you guys are asking. So, Natalie, can you talk a little bit about what kind of openness and responsiveness that really helps operators for you?
That's an interesting question. So, we are not the IRS. We are not, the state governing board. We're here to help you, help us help you. So we ask a lot of questions and it may seem sort of invasive, but we're just looking to see how we can maximize your deductions. And so, if, especially like Chris said, if you're coming out of an environment where you were maybe kind of going under the radar and not quite as legal as you could have been, you maybe don't want to share a whole lot of what you're doing. But we just need to know what you're doing. We're not the government. We're here to keep you within the confines of legalities with the government.
Absolutely. We are not narcs. We're on your side. If we're asking
Correct.
questions,
Yeah.
we're not trying to get you
Yeah.
in trouble. Trying
Yeah.
to figure out what's
And
going on.
and again, it may seem a little bit invasive, especially, what's more personal than your finances and your money. But we're like doctors and you see bodies every single day.
Yeah.
So, we've seen it all, we've heard it all, but we're really just trying to find the best plan for you.
Yeah. And if you hide something from us, I mean, sometimes we encounter a lot where people are embarrassed, say, about
Mhm.
the state of their finances or what's going on. But it's like with a doctor, if you don't tell us, we can't fix it. And so
Correct.
It's really, that openness is really important. And then related, and kind of the last point here is I want to talk about record keeping best practices. What should the documentation process be like? What should you be holding on to, and for how long? Jessica, why don't you start talking to us about that?
Yeah, so ideally, you would be using some sort of accounting software. I mean, obviously, a popular one is QuickBooks, just to keep track of all of your income and expenses. Like Natalie said, it's really important that we see the whole picture and we have the whole picture. And so, an easy way to do that is to use an accounting software like QuickBooks. And then what's nice about that also is you can share that with us. So we can ask less questions. If you don't want us asking a lot of questions, if we have access to that, we can kind of find some of the answers to our own questions just through that. Another point is, like Natalie mentioned, keeping all of your business expenses through a business account. But with this industry, it's pretty difficult to get a business account. So one recommendation that I have is, if you're not able to get a business account, or you're in the process and it's just taking a long time, one thing you could do to try to help yourself with this record keeping is open a separate account. So if you have like your personal checking account, if you could open another checking account and you just use your one account is your personal expenses and your other account is your business expenses, then that can really help you when you are doing your record keeping, because you know everything in account X is your business related expenses. So if you lost a receipt or you forgot about an expense, you can look at your monthly bank statement and realize like, oh yeah, I did buy that or I did spend that. And it kind of helps you with keeping track of that. Also, a lot of the accounting softwares similar to like QuickBooks, you can link certain bank accounts where it'll automatically pull in your transactions. And if you're using one bank account for both personal and business, it's hard to do that. But if you have one account that's just business, you can have it automatically pull in those transactions, and it kind of helps you with your reconciliation and making sure that you're having all of those income and expenses being reported in your books. And then you just have to tell the software what it is. And the software these days is pretty smart. It starts to remember. And so you just have to say, yep, that is what that was. Or no, actually, this time I spent it on something else. So that's like a huge, huge tip on how to make things easier and a bit more efficient. Also, it'll help you with your deductions, because a lot of times if you're just kind of going off of memory, you forget about expenses that you've had throughout the year. But if you're keeping track regularly, you're not missing those little expenses here and there that really quickly add up. Also, it's important to keep your records for as long as possible, especially during your audit windows. So for a tax return, you definitely want to keep your supporting documentation for at least 3 years, because the IRS has 3 years to come back and audit you and ask you to prove those expenses. So that would be receipts and record keeping, profit and loss, balance sheet, those type of things. For payroll, you probably want to keep it a little bit longer, probably 5 to 10 years. And this day and age, with everything electronic, if you have the space to keep it, I would keep it. But if you have like a big box or something of receipts somewhere and it's past the 3 years, you could go ahead and purge that box of receipts.
But I would say hold on to actual tax returns forever. Just to
absolutely.
sort of add on to what Jessica was saying.
So how often do you guys encounter boxes of documentation, let's say, because you're talking about how important it is to be digital and be updated? Are still people sometimes sending in paper documents that you then have to manage and go through?
It's not as bad as it was, like, say, in the 80s and 90s. And I've been around that long to have received shoe boxes full of information. So it's nicer these days. And like Jessica was saying, if you have a bank account, everything is digital. And so you have a digital footprint of basically everything that you've done. So, and we are more of an internet-based firm. I do still have clients who do send, some hard copies of things. They're just maybe a little bit older. They're not comfortable with using digital media as most people are, and that's fine. But yeah.
Yeah, that's great. Yeah, and so next let's talk about, we did get a couple of specific questions from our Instagram audience, so thank you to anyone who did respond to the prompt earlier this week. If you don't know, give us a follow, GreenGrowth CPAs. We're posting a lot of content on there and links to stuff like this and so on. So the first one is pretty direct. Can you deduct expired product? And there's no information in the question about what vertical this person is in, but in general, or just kind of talk generally about that.
Well, in general, I mean, the easy answer is yes. So if you have product that you can't sell for whatever reason, you spent money on this product, and I'm assuming that it's been accounted for in your inventory. So basically, you figure out the cost of that product, and when you take it out of your inventory, it's reflected in your inventory numbers. So that would be reflected. So basically, yes.
Okay, so in most cases, are there any cases where that's not doable?
I can't think of it. I can't think of anything, because
Yeah.
especially if you did, and this is sort of, eagle's eye view, looking at stuff big picture. But if you spent money on something to sell, and it's been accounted for in your cost of goods, and we can go over how you come up with the cost of goods number, which is an entirely different conversation. But if it's been accounted for in that number, then yes, when you take it out, your cost of goods is going to be reflected in that, and that number is going to change.
Sure, that's great. Cool. Next one, another very specific one is, do you need to file that Form 8300 when accepting cash from investors?
Yeah, so if you're taking cash from anybody of 10,000 or more, you would need to fill out that form. However, that excludes checks or like credit cards or anything like that. So it'd only be cash. So if they're for sure just handing you a stack of hundreds, then yeah, you would need to fill that out. But if they're giving you a check, no, you wouldn't need to fill that out.
Yeah, so it seems like just the general rule is if you're getting a transaction, it's over 10 grand, do Form 8300, right? It's just better safe than sorry.
And
In cash.
yeah,
Yeah, for cash,
the
yes.
8300 is a pretty simple form. It's not like it's a long, financial statement driven form. It's pretty simple, and it has to be sent in, 15 days after the transaction. But again, it's very simple, and I would be very safe, safe than sorry, because there are heavy penalties if you don't file the form.
Yeah, absolutely. And then our last question is a good segue in kind of the next section we're talking about. Biggest question it seems like we get from everyone is, what can we deduct? What can't we? And someone specifically asked, what are the kinds of deductions a cultivator can take?
Yeah, so a cultivator, the nice thing is cultivators have it a lot easier than retailers or delivery services. Cultivators can deduct almost like a normal business because most of what you're doing is related to cost of goods sold. So there's like equipment, almost all of the equipment that you're using is related directly to creating the product, whether it's using like the growing or the manufacturing or anything like that. Also things like soil and nutrients and, a lot of the electricity and utilities and the grow lights and the greenhouses and all of that stuff is deductible for a cultivator. The one thing that isn't always 100% deductible is some of the payroll. It kind of just depends on what the person is doing, but a majority of the payroll is typically deductible for a cultivator.
What are the breakdowns of at what point is someone's work not deductible under cultivation?
So a lot of the administrative type duties are hard to argue as a deduction for a cultivator, but pretty much anything dealing with like inventory management or the actual growing, manufacturing, all of that part into the creation of the product, managing the inventory, that whole process, all of that's deductible. So as you can see, most employees, that's what they're hired for in the cultivation. And then there might be like a manager or the owner or something that receives a paycheck that is a little bit more on the admin side, but even them, I mean, usually over half of their time is spent in the actual process of growing the product and getting it ready to sell. So most of the payroll is deductible. There's just a few people here and there that sometimes you can't deduct 100% of their wages.
Sure, great. Worth noting that we did just publish an article on Tuesday that's sort of an intro to inventory cost accounting for cultivators. So head to our website and check it out. We'll be doing more articles looking at the different verticals and the best way to do that. And yeah, we're sharing the secrets a little bit about how we help get those deductions. It's what we're all about, just educating the industry. So Natalie, then let's talk a little bit about retailers and dispensaries. It starts to get a lot more complicated. Can you address that?
Yeah, it's almost like you go into this business and cannabis, it is medicine, let's be honest, but you're going into this business to help people and you're kind of having to do it with your hands tied behind your back. So a lot of, the big, beautiful cannabis retail spaces that we are seeing, most of that front space with the beautiful display cases is not going to be deductible. You do have to spend money on fixtures to sell the product. And unfortunately, we just can't get that into cost of goods. And cost of goods is the name of the game in deductibility in cannabis. Your bud tenders, your people selling the product, we cannot use those wages. However, if those same people, if the proper documentation is held, if they are in the back and they're doing anything inventory related, they're putting labels on, they're filling jars, they're doing whatever in sourcing the product, we can maybe allocate a certain percentage of their wages and their associated payroll taxes and et cetera to cost of goods, because they're actually touching the product, sourcing the product, helping to sell, but selling the product we can't use.
And there are certain circumstances depending on what you're selling, right? So if you have a CBD section, or if you
Sure, or
have,
accessories, if you're selling t-shirts and vape pens and unfilled vape pens or bongs or anything like that, we can also allocate a certain portion of deductibility, based on your sales.
and what do you need to be able to do that from the tax perspective? You need some really precise documentation, right?
Correct. And even in the case of your employees changing their tasks from sales to maybe in the back, we've even said, go through a different door, maybe clock in, clock out, do something that there's a white line that shows that I'm doing something different, because we want to just overly record everything, because someday you probably will get looked at by the IRS, and we just want to have all of our ducks in a row and show that we followed all the rules the best we could.
Absolutely. One of the few things that we've really gained from all those tax court cases, which have never really gone to the side of cannabis, is that
Never.
yeah, we've gotten some reductions, but never, haven't changed the laws yet. But that showing good faith is really key to the tax courts, because what they're really looking for is trying to catch criminals, essentially, who are trying to evade tax law. But tax courts have openly said that 280 is confusing, that there's not, all precedents have not been accounted for. And so there's some leeway there. And that biggest thing that they look for is good faith. And so if you're doing that documentation and you can show that, no, was our understanding of 280, this was not an attempt at fraud, then you get that leeway, right?
Correct.
Mm-hmm. Great.
I agree with
That's
that.
a great segue then into sort of the last thing we wanted to talk about, and big issue for everyone. We've published a few things, and it's well known in the industry that the IRS has made sport of auditing cannabis companies. They do it at a higher rate, and they're much more successful than mainstream industries, partially because of the complexities. And so the very root of everything that we are doing is trying to help folks avoid audits, and in the worst case scenario, be prepared if inevitably the audit comes. So from the perspective of a tax preparer, what are some of the red flags that you're helping people avoid? Why don't we start with you, Jessica?
Yeah, so a big one is consecutive losses. So I know that in cannabis, it does take a little bit to get fully like up and running and things like that. So, I mean, legitimate losses are legitimate losses, but it is a known common red flag for the IRS that when you have too many years of consecutive losses, that it's kind of a trigger for them to look at the business and say, is this a legitimate business? Are you in it to make money? Is this more of a hobby? They're kind of looking at all of those things. And typically a good rule of thumb is 3 years is what I tell people. Like after 3 years, if you still haven't been showing a profit, that's where you might start to get on the radar of the IRS of, is this a legitimate business or is it more of a hobby type of thing? And I have seen businesses go past the 3-year mark and still show legitimate losses, but hopefully you're getting closer and closer to showing a profit at that point. And again, like Natalie mentioned, documentation is key. So having all of that in case there is an audit open due to that. Another big one that I see often is, especially like earlier when we were talking about making sure you keep track of everything, and sometimes that's not always the case. And at tax time, people are just kind of scrambling to pull their information together, is round numbers. So a lot of times people will be like, oh, I spent $1,000 on this or 2,000 on that or 300,000 on this. But a big red flag for the IRS is if all of your expenses are ending in zero. Because if it looks weird to me, I mean, the IRS isn't dumb. They're thinking the same thing. Like, what are the chances of every single expense you have ending in zero? It looks made up. So I just always kind of tell people, keep that in mind. And again, that's another benefit of keeping track of all of your expenses in like an accounting software or something throughout the year, or even if you're manually doing it in Excel or pen and paper, if you're keeping track of the actual expenses, the chances are low that all of your expenses are going to end in zero. So then you should be safe from that red flag. And another big one is just making sure that you're filing on time and you're always filing all the correct forms. Even a big one is even if you have zero for the year. So if you're going to show a loss or you have zero income, you should still file the zero return to avoid the IRS questioning why you filed, because the IRS knows your business. You have an EIN number. They know that you should be filing a return. They just don't know if you had zero income or not. So even if you have zero income and you're like, oh, I don't need to file because I had zero income, zero expenses, this was my first year or whatnot, the IRS doesn't know that. So they're going to question why you didn't file. And so it's just kind of best to avoid being on their radar at all. And to do that, you just file a zero return.
That's great. Thank you. And Natalie, any other red flags to
Well, I think
out?
Jessica pretty much covered the big ones, and going back to filing on time too. Make sure you're filing within your particular tax year. So if you're filing, gosh, I didn't file for 2017 and 2018, and I'm doing it right now. Well, you're putting a bigger target on yourself for the IRS to say, let's take a closer look at that number. So, when you're filing, when you're supposed to filing, and you're filing when everybody else is filing their tax return, you're kind of going in with the flow, and there's less of a target on your back.
Yep, absolutely. All right. So promised you guys half an hour and we've just hit it. So I just really want to thank you guys for making this time for us. We're going to be doing this every month moving forward. We're just going to be taking a look at what's happening in the tax landscape, offering any advice and answering any questions. So special thanks to Natalie and Jessica for joining us today. You guys did a great job.
Pleasure. Thank you.
And thanks to the audience for joining. And stay tuned. We'll be doing the same thing next month. And as always, thanks.
Thanks.
Bye, everyone.
Bye.